Please join me in welcoming to the stage Mark Cutifani.
Mr. Malnick, industry colleagues, ladies and gentlemen, it certainly is both a privilege and certainly a pleasure to be here with you today. Before I kick into the presentation, what I'd like to do is earn $1 for my company, and I'll do about 7 to 10 minutes on AngloGold Ashanti, provide a little bit of context so that you understand where I've come from and what we've been doing as a company for the last 5 years or 4.5 years, and then I'll go into a broader commentary regarding the industry. So I'll churn through this very quickly, and I hope at the end of the next 7 minutes that you'll feel compelled to go out and pick up some AngloGold Ashanti shares. AngloGold Ashanti, I'm just making sure I can see it. AngloGold Ashanti is a global company, global gold miner. We operate across 25 countries, currently have operations in 10 countries, and we're exploring in another 15. We are, at the moment, the most global of the major gold players. We're number 3 in the world. Within 3 years, we'll be number 2. And as we said, there's a target on Barrick's back, and we'll get there within 5 to 7. But most importantly, we're focused on value and creating value. And that's where all of our conversations start in terms of what we do with the business and where we're taking the business. In the last 4.5 years, we've been going through major restructures. We had a 12 million ounce hedge book. It's gone. We put $6 billion into taking out a hedge book. Today, if we had those ounces on the books, the mark to market on that hedge book would be negative 16 billion. So we're 10 billion to the good on that decision. And for those that know my history and my experience with hedge books, you wouldn't be surprised that was the first thing we sorted out. Major restructuring across our operations, including significant performance improvements in safety and across all of our operations globally. Been very important in terms of getting the engine working. And today we are the most successful gold mining explorer. And if you look at the value of the products we've found over the last 5 years, we would lay claim to be the most successful major industry explorer, and we continue to have a significant commitment to exploration, both in terms of gold and more recently silver, copper and uranium. In terms of running the business, we've got the basics right. 70% improvement in safety, 80% better improvement in environmental incidents across the board. We're working on all the basic issues and making sure that we're managing, obviously, with our people and for our people. We're managing our relationships in the community. We have significantly changed the way we operate. I've said consistently, for those that know me well, in the last 20 years that I believe we are some 20 to 30 years behind the manufacturing sector in applying process and science in terms of the way we run our processes. So in AngloGold Ashanti in the last 5 years, we've actually implemented a model that looks a bit like the Toyota management model, but it goes far beyond that because it took Toyota 50 years to implement. We're trying to implement the same sort of approach in less than 5 years. And what you can see there is literally performance improvement of our production processes in the mine and mill operations in Siguri in the middle of Guinea. About 23% improvement over an 18-month period as we've implemented our new operating processes. No capital. This is just about people. This is about 97% of the workforce that have never seen an industrial process, coming direct from farms, speak a number of different languages that we've had to train from the ground floor up in terms of basic education, and we're implementing and delivering significant performance improvement across the continent of Africa. And just to give you a sense of what that looks like, when we looked at our assets across the group 4.5 years ago, we were facing a 30% reduction, mainly because of reduced resources, reduction in grade, the quality of our resources that we hadn't been building, and in fact the company had shrunk about 40% in the preceding 7 years. So we had to really understand where the assets were and what we had to do to turn the business around. So on the top left there, you'll see that our grades have declined more than 20%, but through the operations improvement and the manufacturing type approach, and it goes beyond manufacturing and we bring it back to the basics in mining, we've improved our throughputs by 18%, again without significant capital, so that we've held our production levels constant. But more interestingly, as a company, instead of seeing operating costs increase, as you would expect with that sort of grade profile, we're actually seeing absolute cost reduction. Gate has gone from $1,000 an ounce to $550 an ounce. Guinea, a 20% reduction. We've seen reductions right across the portfolio as we've implemented fairly sophisticated manufacturing approaches through the continent of Africa, in Australia, North America, South America, wherever we've got operations, and so significant improvement right across the board. At the same time, you'll see that our performance against budget forecasts, and so if you look at 3 or 4 years ago, we were on average missing our budgets in continental Africa by more than 25%, partly through optimism, partly through ignorance in terms of understanding what was happening in the assets, and partly through not understanding how to maintain and operate in a difficult environment. And today, in the last 3 quarters now, we've actually nailed our budgets, but you can see consistent improvement over time as we've introduced those types of processes and approach across the mining operations. And whilst the maintenance people were already used to operating in a structured, planned way, introducing those processes and approaches to the things we do within the operations was the big change, particularly for management. And as a consequence, we've seen an 80% change in the top 100 roles in the organisation, and of that 80% change, 41% have been recruited externally, and the other 41% have actually been internally developed within the organisation, but they talk a different language and they operate in a different way. And if you're changing the way you operate across 20 operations, 63,000 people, it's a big change program, and it's certainly been successful for us. If I look at the business and the 16 operating centres that we have across the globe, back in 2008 we actually ranked the businesses on a scale of 1 to 5. 1, which is a red dot, indicates an asset that was bleeding more than $50 million a year in cash flow. Brown was an asset that was not performing, didn't have a plan, but had the good fortune to maybe have grade or some other physical characteristic that helped it not bleed $50 million, so it was bleeding something less than $50 million a year. A yellow is an asset that had problems but at least had a plan and was tracking a plan to turn it around. Green was an asset that was delivering on its budget 4 times out of 5, and blue was an asset that we thought was best practice. So of the 16 assets, a 5, if we had 16 assets at 5, that was a raw score of 80. In 2008, the score for the assets and where they were operating was 34. And you can see cash flows on the right from the business, or EBITDA on the right, about $1 billion EBITDA. So as we've moved into implementing the new operating model, you can see that the colours have changed significantly. There are no reds. We've got still lots of potential to improve from where we are, but each of the assets has either got itself moving or is at least improving, and those browns that still remain are not tracking their improvement plan, but they've certainly got an improvement plan for every one of the assets, and the raw score now is 63 out of 80. And the important measure in terms of have we made progress, EBITDA's gone from about 1.1 billion, that's the chart on the right, to over 3.3 billion on less production. So we've more than tripled our EBITDA delivery in terms of the business. The gold price and taking out of the hedge book has delivered about 60% of that improvement, and about $1 billion worth of free cash flow improvement from the asset base has been delivered as a consequence of the delivery of the new operating model. And it's still only about 60% of the way through the rollout across the business. And each site is in various stages of the rollout. It was a 5-year change program. and we're about 60% of the way through the change program, and we've seen a trebling of EBITDA contribution across the business. We actually measure progress, and progress only gets into this chart, which is a tad under $1 billion, if it's sustainable. So it has to be a sustainable tonnage improvement, a sustainable grade improvement as a consequence of a different mining method, a sustainable recovery improvement, or a sustainable cost reduction. So reducing contractors for a 12-month period doesn't qualify as a sustainable cost reduction. It has to be a structural cost change, and it's audited and reported to the board on a quarterly basis. And that helps us maintain the discipline right through the organisation. In terms of where we've come in the last 18 months, for about 22% improvement in gold price, we've delivered a 39% improvement in earnings. And I was asked the question before I came in to present about why would you invest in a company like AngloGold, and the main reason is, in our view, that for every 1% improvement in the gold price, we will deliver you 2% improvement in our earnings. And that's what we've delivered over the last couple of years in terms of the underlying improvement across the business. And to go with that, I'd make the point that unlike many of our copper-hedged peers, of which Australia has its share in the gold industry, that have seen 10 or 15% earnings improvement in the last 12 months, 90% of our revenues come from gold. And so if you buy AngloGold Ashanti, you're buying gold, you're buying globally the most diversified miner in the world. If you want to bet currencies, don't buy AngloGold. If you want to bet gold and you want to bet leverage to gold, buy AngloGold Ashanti, because it is the most global of the global miners in terms of its geographic spread and where we're developing, and it is the most successful explorer in the last 10 years in the industry, in particular in the last 5 years, and I'll show you a little bit later, in the last 6 months, 5 major new discoveries in gold alone, with some copper thrown in as well. So I may have to sell that copper to one of our copper-hedged producers, being a Barrick, a Newmont or a Newcrest. But in terms of gold operations, you want to invest in gold, invest in AngloGold Ashanti. We are growing the business. In the next 2 years, we'll actually grow the business around 25%. Unlike many players in our industry, we actually do identify the depletion that we'll see in our assets. We have contributions coming from greenfields and brownfields expansions. So significant improvements in the business, and again, going from contraction, tightening down, cleaning up the business, getting the foundations right. We're starting back into growth. And for us, over the next 2 years, a very important period in the life of AngloGold Ashanti. Somebody asked me about the operating improvement and said, well, you guys seem to have done well on the operations side. The most significant improvement across operating areas in the gold business, and probably most of the mining industry. I said, well, we're not a one-trick pony. We've certainly made some significant improvements, and we're growing from our organic base at about $1,500 an ounce through our operating improvements. And by the way, the industry average for bringing on a new ounce of production is about $4,500 an ounce. That is the North American average in particular at the moment. In other areas, it's actually climbing above that. So we're bringing on new production incremental to our current assets at $1,500 an ounce, which is less than $100 an ounce over the life of the asset. From new projects, Tropicana and Mongaloo in the DRC, and we talked about the DRC, we're currently spending a bit under $2 billion in the DRC on new projects. We're developing new assets, and this includes acquisition of Moto, for those that may be aware of the asset. We're developing those assets at around 2,200. That includes acquisition and project development. And on acquisitions, we've spent about $1 billion in the last 3 years, and that $1 billion in our hands is worth about $3 billion today. And the new gold that we've brought on stream with the capital on top of the acquisition price is about $3,500. So I'm guessing Newcrest's acquisition of Lihir would have been about twice that value. So from a competitive point of view, we are very much focused on making sure that whatever we bring to the table has the margins and is able to add value at certainly today's gold price, and even in more difficult times, as we expect over time things do occur. The way we think about our business is we take a view on the price of the commodity, not so much in terms of establishing a hard-wide margin, but in terms of competitive position. Today it costs $1,250 an ounce to produce an ounce of gold. That's adding capital and everything else. We try and keep ourselves below that point. I've got $1,280 as the current cost. We're trying to keep ourselves under a total cost, includes acquisition, exploration, everything else you throw in. We're trying to keep ourselves under $1,200 an ounce, and all of our new projects are actually under $1,100 an ounce total cost. So we remain competitive with good margins, and that's how we build up the cost. Now, at the end of the day, those costs don't necessarily have to land $30 an ounce on exploration and development capital. It can be any one of a combination, but we've got to keep our total cost structure below the industry midpoint so that we can continue to deliver real returns, because the days of gold companies issuing equity every 2 or 3 years to top up what they've blown in the last 2 or 3 years is gone. We have to run real businesses, generating real margins, generating cash, and providing dividends and other value-adding instruments to our shareholders. And we're very much about mining. In exploration, we're committing with our brownfields and greenfields programs $300 million a year in exploration. In the last 6 months, we've found 5 new deposits, each likely to deliver more than 3 million ounces. We have the most successful gold exploration team in the world, and in fact 7 major discoveries in the period prior to that put us as number 1. And with 5 major discoveries in the last 6 months, Colombia, a couple in Guinea, in Egypt, in Djibouti. We've been very successful, and we will continue to explore and spend money on exploration, because for us it's where real value is created, and given the success of the team, they're actually delivering new gold into our portfolio at less than $30 an ounce. And in terms of value, we think the exploration portfolio is now worth more than $10 billion. And we've got a total market cap at $14 billion, which is well under what we see as the intrinsic value for the business. And our exploration portfolio alone is something to be beheld in terms of potential. And for those that may have missed it, in our last quarterly results, we've announced a major new discovery in Colombia, 700 metres copper gold mineralisation, copper porphyry, 200 metres of cover. The target is north of 1 billion tonnes, and we're hoping north of 1% copper grade and equivalent. And that hasn't got much airplay thus far, but certainly from our point of view, we think it's got significant potential, and it goes with Colossa, which is a 25 million ounce discovery that we have so far. We think it's got the potential to go over 40 million ounces, and we're developing, in fact we're going from pre-feasibility to feasibility with a new deposit called Gramalote in Colombia. Certainly the social challenges are significant, but it is a good regime. The government's very supportive of mining, and we certainly think we've got a great future in Colombia. The other thing we're doing is we're very, very involved in research and development, and I'll talk about that in terms of our industry. We're committing to the development of new mining methods in South Africa, and instead of the traditional drill and blast, progressing with 18 people working on a face in areas that are subject to seismic activity, we're looking at horizontal raised drilling. Reef structure is about 1 metre thick. We can actually extract that using a raised drill, and in fact on Friday 2 p.m. last week we completed our first hole on the reef structures in the Witwatersrand, and if in the next 5 years that's successful, we're targeting a 30% reduction in our cost, but more importantly we believe we can mine for the first time safely and without fatalities for the long term and beyond 5,000 metres in South Africa. And if that is successful, that'll be the most significant change in the mining industry in the last 100 years, because we also think that technology is applicable to narrow vein vertical deposits. And so not only are we spending money in exploration, we're also putting our dollars where our mouths are in terms of research and development. And if this works, then you will see South Africa talked about in a very different way in terms of the gold industry at 4,000 metres. And for us, these could be significant changing events, and from our point of view, also very instructive in terms of where I think the mining industry has to go in the future. Finally, 2 key points. Measuring success, 29% return on equity And in terms of enterprise value over EBITDA, one of the lowest ratios in the industry. So for those that understand those two numbers, we argue that we are amongst the best value buyers in the industry. It's just the management has to do a much better job in selling the story to people like you. So a lot of work to be done. We've gone through major restructuring. We're delivering results. I think the most important thing is to continue delivering results, and I think over time the market will reward us. We're currently market cap of 14 billion. As I said, I think we're well under intrinsic value, certainly in the numbers we do, and talking to a couple of shareholders that have recently joined us as partners, I think they see the same potential. But it's a great place to work. South Africa is a great place. I'll pick up a few points, but that's very much the AngloGold story. And as I said, it's a fairly simple story. Today, delivering cash, we've gone from $1 billion to $3 billion in terms of EBITDA, and with our expansions over the next two years, we'll take that north of $4 billion. We have a tremendous growth pipeline, both from the assets we have and in terms of the exploration potential we're generating, and we've got a tremendous track record in being able to identify and execute acquisition projects. And in terms of the future, the ground positions we have in the Nubian Shield in the Middle East, in continental Africa, in Colombia and through South America, I would argue the best exploration addresses in the world of gold, and many would argue in terms of copper and other positions as well, given what we've just found in Colombia, and we have a number of new prospects that we're chasing there. So that for me was the quick sales job. I will now go into
Thank you, Mark. Before we open with questions from the journalists, please.